Hey guys, welcome back to the show. Today we have a great guest. So if you're thinking about getting into owner financing, you need to know a little bit about what you're doing, right? Because there's a lot more to it than most people think. And we're talking about loan servicing today, which is a huge asset for an investor getting into owner financing. We have probably what I would like to say the fastest growing, if not the biggest, loan servicing company in North Texas. The owner of this company out here today on our podcast, and she's going to talk a little bit about the loan servicing process for you. So I'd like to introduce you to my guest, Amy Sayre. How you doing, Amy?
Hi, thank you for having me.
So, Amy, you run the company August REI, which is basically everywhere right now in DFW. You can't go to an REI club or an REI expo without kind of seeing your brand there. So can you kind of tell us how you got into the loan servicing and how you kind of built your company and kind of the whole process? Because I know in the past few years, y'all just kind of exploded here in North Texas, and y'all are helping a lot of people with the servicing of their loans.
Well, thank you. I'm glad to hear we're all over. We're actually doing quite a bit down in the Houston, San Antonio area, also in
Okay.
Austin. I got into loan servicing because there was a need. Loans that we're managing in our family's portfolio weren't being serviced the way we had wanted, and were causing additional accounting issues because we were getting dinged $5 to $7 for a collection call, and money wasn't coming in, even though I was having to book out $7 because someone made a 10-second phone call to get a busy signal. So I kind of got fed up with that and made a question to my mother, and she said, well, you can either like it or you can figure out how to do it yourself. And so the gauntlet was tossed, and that's what I did. I set out and thought, I can do this better. I'm going to set one up that has a flat fee. Everyone will know exactly how much money they're going to get every single month. And when they go to book it in their QuickBooks, it'll be easy. And it will be just an all-encompassing flat fee. And I really wanted to pursue the ability to have borrowers being reported for credit. We report to Equifax, and we started working on TransUnion because I think it benefits if a lender wants at some point for their borrower to be able to refinance, that they would be able to, and it improves the borrower's credit. So I wanted to do something that would benefit the borrowers and myself as a lender, so it would be a win-win.
Yeah, so that's pretty common from what we're seeing a lot lately with a lot of our guests is that it came out of a necessity from a frustration in their own life on something that was not working for their own business. And they're like, you know what, I can just do it bigger and better than everybody else. So I'm just going to kind of do it on my own. And so I see this commonly. So now loan servicing is not something that most people probably understand. Most people are wholesalers, landlords, rehabbers, right? And then they kind of start to transition to more creative types of financing, and then they're like, oh, and then they start to hear all the benefits of owner financing, and they just want to jump in. But y'all do a lot as far as servicing these loans. Can you kind of break down the loan servicing process, the benefits y'all offer to an investor, and why it's just kind of worth it? Because even you service our loans, to why it's beneficial to use a loan servicer and pay that little bit extra money each month just to kind of set it and forget it and say, y'all deal with it. Y'all are the best at dealing with it. I don't want to deal with it. Just tell me when I get my check, right?
Exactly. I think the highest benefit would be, well, I don't know what the highest one is. Well, there's several. I think part of it would be that if anyone decides at some point they need to sell their note to increase capital or go to something else, a note that is serviced sells at a higher rate and has a third party certifying when the payments were made. The other part would be we have a bilingual staff, and it's what we do all day, every day. So we're not going out to find the property, make the next deal. We are servicing the loan. That's what we do day in, day out. So we're collecting the payments, depositing them into lenders' accounts, so they're receiving the money. We're doing the end of the year tax statements. I know a lot of lenders like that we do the 1098s and 1099s because it's our tax ID number on the borrower's 1098 and not theirs, so the borrower doesn't have their social security number. And we maintain their escrow account. And any owner finance note that's 1.5% higher than the current APR requires that an escrow account be held, which basically any loan that's over 6%. And most of our owner finance notes are over 6%. And if they're not, they should be, so that people are making their money on it. But we hold the impound account. We do the required escrow. We calculate the payoffs. We send the monthly statement with all the required information on it. We report the credit, and we collect the payments, and we do the collection calls, and we keep compliant with fair debt collecting. So, I mean, it's a lot of moving parts. I think that's probably the thing that we've had people come in and they don't realize how much is also involved. They're like, oh, the borrower sends you payment, you send it to me, and you charge that much? Is that really fair? And I'm like, yeah. We've got a lot of paperwork here and compliance to deal with and, make sure we're with Dodd-Frank. that's probably the biggest part, is just making sure we're compliant and the statements are getting out and payments processed in a timely manner.
Yeah. So, guys, she gave you a ton of good information right there. So, basically, what she said for y'all who are new in the business is they do everything for you that you don't want to have to do, and they do it really good. So, basically, and another thing she pointed out there is because here in Texas, our Hispanic population is booming, right? And so, a lot of the times we're selling these houses on owner financing to Hispanic families, and there is a true language barrier for a lot of people. And what she says, they have a bilingual staff that can help you kind of bridge this problem for a lot of investors. And also it helps those family members, have the pride of home ownership and get into a house, and you have to be able to service these loans somehow. Now, one of the things that I like that y'all do is y'all collect the payments, and if my borrower is not making the payments, y'all contact them, y'all handle that headache. Y'all are the ones that kind of go forward and do all that for us. And most of the time, we don't even know that this is going on unless really we call and ask, right? She's doing a lot of things for these investors here in Texas. And basically, we can go out and do what we do, which is find houses and do deals, and they can handle all the kind of back office stuff. So you can kind of talk about what y'all do as far as collections and what happens if they're not making payments.
Yeah, we have a collection team. They are bilingual. I was going to say, out of our staff, I think we have 15 people. There's 4 of us that don't speak Spanish.
Wow.
I would be included in that. I have very limited Spanish. I know how to transfer a call and tell them to hold on a second. Un momento. It's my big Spanish word. But the collection team makes phone calls. They log them in the system. They send out messages. We can send out messages via text, we leave voicemails, we email, and they send out notices in the mail. But once we reach them once during a day, and we have to read what's called a mini Miranda, which is that, any information gathered is being used for the point of collections. It's a whole long spiel, but I'm not going to recite it. It's not that exciting. But we do that part of it, and, the collections, and make notes in the system, and just, have them say when they can pay. And occasionally they'll say, I can get in $600 this week, and it'll be next week. And we're like, okay, well, let us get with your lender and see if that'll work for them and what we can do for you. Because the key is to make sure that we're communicating.
Yep.
And getting messages. And we try and do that when we make our welcome call and set up a loan, and let them know that it's really important that they communicate with us. That, if we don't know what's going on, then, they have to move forward with legal action. And it's better just to communicate and work together.
And so the guys, Amy and her team, they stay on this process. They stay on top of it, put it that way. And I think a big advantage for us as investors is sometimes when we're dealing directly with the homeowner, they don't take it as serious. Sometimes you have that landlord-tenant relationship, or that owner-occupant, buyer working with you, and they're not going to take it as serious as if they have a third-party company contacting them saying, hey, basically, get this in, get this done right now, or, the hammer's coming down, right? And so I think it creates a little bit of extra leverage on them, knowing that there's an extra party involved saying, hey, look, now it's 2-on-1, basically, if it comes to, an argument or dispute later. And so I think that has a big negotiation point for y'all as far as getting those payments. Do you feel like that, or how do you kind of look at it?
I think having previously managed my own rentals, them not talking directly to the lender and giving a story which I'm sure can be true most of the time or not. The point is that we have to collect the payment for the lender. You live in the house and you have to make your payment. You made a contractual obligation, but the staff will listen to them and sympathize with them. But at the same point, the bottom line is we need to know when you're going to get your payment in.
Exactly. Okay, so let's take like a case study example. So say I bought a house and I'm getting ready to sell it. I find a buyer. What is the best process? Because I know you have an RMLO in there, a loan originator at y'all's office now, I believe. And kind of let's talk about the best process as far as going forward and creating a loan, servicing the loan, as far as selling that loan to get the highest, without having to discount it, basically getting the highest price for that property, which is what we're all trying to get. And so what they do, guys, is they keep good record of it. And she mentioned earlier that you can sell that note for a higher price when you have everything documented and done well, especially from a reputable company like August REI. And so you may pay a little bit extra month to month in the front side, but you get it back times 5, 10, or whatever it is. You're going to get an exponential return back on the back end when you go to sell that note. So you shouldn't be so focused on the fees, and kind of explain the process of creating the loan and how y'all service it, getting it ready for us to sell it, I guess you could say.
The creating the loan part would have to go to Carol if you wanted to talk to her on the loan part. I was going to say, she's also our office manager and comes as a broker and an RMLO, which is handy to us because she's, making sure things are getting crossed and dotted over there. But for our part, we need to get the borrower's setup information and a copy of their social card or a W-9, and the lender setup information, a copy of their SS4 if it's a business. And we're going to set up the account for direct deposit, and the borrowers we set up the whole loan. There's a process to that. It's pretty long and lengthy, but overall, the other part is it's set up. We make a welcome call to the borrower. We send them a welcome packet out, and it lists, there are 5 different options to make a payment because our goal is to make it easy so they can get their money to us in a timely manner so we can get it back out to the lender. You were talking about the fees on that. Usually we see lenders paying the setup fee, which our setup fee is $50, but borrowers paying for the monthly servicing because it benefits them to have it reported on their credit. So in actuality, it ends up only costing the lender $50 over the time that we service the loan, whether it be 10, 15, or the full 30 years. Or if they pay off early in 3 years, the lender's never paid for it. They write language in the note that says that the maker or the borrower will pay for the cost of loan servicing over the life of the loan. The current cost is $35 a month. This may increase or decrease over the life of your loan. And we've had our fees they've been about the same for the last 7 years. I plan on seeing them that way too.
Now, when Carol does the RMLO, traditionally, are you having the borrower pay for her fees too, or is this being done by the investor traditionally, or how do you?
Well, a borrower does, but she does that as a separate company. It's not as of an August REI part.
Okay.
She's through Town Square Financial.
Okay, yeah, we'll probably have her on here too. so people, because we've had.
I can answer for that part. But, there's many RMLOs out there and attorneys, and we service them all.
Yeah, so basically, guys, that's a loan originator for you, residential mortgage loan originator, which is another part of the process which you want to make sure you have done correctly, because a lot of people who are owner financing properties don't want to leave their capital out long term, so they're going to have to sell the note. And so getting a high price for your note without having to discount a lot is very important, and when you're doing this type of transaction. Now,
I always think that's actually a part that people don't realize that we know a lot about. We know who needs to sell a note, and we know who currently is buying notes, and the ability for us to connect the two together. This last month that closed in March, we saw an average of about 93% was the value that they were selling their notes at based on what we had in the portfolio. The highest one actually went for 97, which was really surprising. But it was a good solid note, and it had an RMLO package, and they were qualified buyers, and they've been paying every month on time for 3 years.
Yeah, that's interesting to see, because just a few years ago, people were paying 85 cents on the dollar, and the one that you did for us just recently,
or 75,
or even lower. And so guys, the difference between getting 93 cents on the dollar versus 75 cents on the dollar on a $100,000 note, you're looking almost 20 grand at difference on the price that you're going to get for it. So that's huge. So bringing it to them to service and package it. I don't know what are you seeing typically most people as far as the seasoning that they're having? Because I know the one that you did for us just recently, it was only like a 6-month seasoning. And in fact, she was not even making consistent payments. And we netted 91 cents on the dollar net to us, which is just crazy. Because if you do a traditional rehab after you pay closing costs and realtor fees, you're basically netting the same that you would to flip a house anyways. That's not financeable, which is why most people are going about it this way. So what is the kind of loan structure most investors are bringing their loans to you that you're seeing note buyers paying the highest dollar for?
An RMLO package, a qualified buyer, a whole package saying that they qualified, what their debt to income ratio was. I've seen a lot of pictures from the beginning when the loan was set up. We're seeing interior, exterior pictures when they purchased it, a copy of the insurance deck page, so that they know the insurance has been there. They're wanting to see the whole payment history. And they're also asking us to see what the taxes and insurance are, and if the most recent escrow analysis, if there has been one. We're seeing the highest turn. The 97% was on a loan that was 3.5 years in existence, and it had every payment on time.
Wow.
So
are they
a full RMLO package?
Are they paying a lot of attention to the size of the down payment on the front side when they're selling it, or as far as the credit score of the borrower? Because I know a lot of people kind of get googly-eyed, I guess, over this owner financing strategy because they have gurus going around saying, "Oh, you just buy this piece of crap house, you just owner finance it, and then sell the note, and then you sell it to any buyer, they'll basically bring you a down payment." And then when you get to sell the note, you realize, hey, they do need a good credit score. I mean, not a great one, but they do need to be able to show somewhat that they're not too big a risk for this note buyer, right? Because they don't want to have to take it back.
The ARMLA packages we don't always have access to, but the ones I've been seeing go by, we have seen it predominantly a 10 to 15%. Usually standard is 10% down on these notes. And the terms have been 15 to 20 years. They're looking at 85% of the value of 85% of the note. So if the value of the house was 100,000, the loan balance is usually around 85%. 85,000, so that they have 15% already down. So there's really a little risk. I mean, if the borrower defaulted, and we're, usually they're very solid borrowers, so we wouldn't expect to see that. They would be able to, make their money back in extra if they had to go back and get the property.
Yeah.
That's not the kind of borrowers we have.
So, the timing of the cycling of the cash flow of an investor is really important. The faster we can turn over our money, the more deals we can do, the more money we can make, the bigger we can grow our business. Are you seeing any of your note buyers buying these notes right at closing? And what is the type of discount they're buying them at closing as compared to seasoning?
Some of those are usually going for 85. If they're closing right then and they don't have return because they're going to be serviced and they have an RMO package. The ones that were going at 95, we saw some of those were only 6 months seasoning.
Yeah, that's what I was
saying. They're still going well. The biggest increase we saw was from September 2015 when we saw the increased value on the notes, that people were paying more. And I think it had a lot to do with the volatility going on in the stock market. And we saw a lot of notes being picked up out of self-directed IRAs.
Yeah, so that's
people
really...
that just failed from the stock market. Out of here.
So, guys, what we're talking about here is seasoning. It's basically you're demonstrating minimal risk for the note buyer when you can prove that borrower's making the payment on time, so they know they're getting a performing loan. And what we were just talking about is a note buyer that's willing to buy that note at closing the day you create it. So let's use a $100,000 example. And what you just said is that some of them are paying 85 cents on the dollar, which is crazy to me because, say you're only going to make $15,000 or $10,000 on the house, selling the note, and you're going to get 85 cents on the dollar, but you are going to get 92 cents on the dollar to season it for 6 months, right? So there's just a small increase. But if you can take that money and cycle it every 2 months, buy a house, sell it on owner finance, and do that 3 times over, and you're making 10, 10, 10, you just made an extra 30,000 for the difference of 7,000 that you would have made to hold that for 6 months. So you're creating over $20,000 extra profit to cycle that money quicker. That's and so the fact that people are buying these notes at closing at that higher rate right now is just shows what's going on, at least down here in our market in Texas. So that is what I would advise you to do is to take a lesser amount on the front side if you know you have good deal flow and if you know you can cycle it and bring properties in and out quickly, because that's a big benefit right now. But you're going to have someone like Amy package everything, because if you do it on your own on a napkin and bring it in, these note buyers are not going to look at it the same way that they would with a reputable company. Am
That's
I right?
Correct.
Yeah. So, can you kind of give them? So, I mean, I guess since they're not really paying it out of their pocket, it doesn't really matter. But basically, it does matter in a way, because you have to represent this to or let your borrower know that they're going to be responsible for these fees. So, kind of what would be the normal fees y'all have a month for the loan servicing, and so that people can kind of know when they're selling the house, that they can kind of let these people know when they're coming to buy it.
The setup fee is $50. It's usually collected on the CD, formerly known as the HUD. And the servicing fee a month is $35. It's flat $35 and doesn't change.
Yeah.
So it just includes everything that we do, the servicing of the escrow, the reporting to credit, collections. It has online access for the borrowers and lenders to their accounts to go take a look and track them.
Yeah.
We also send, when we receive the borrower's payment and it's applied, they receive either a text message or an email letting them know we've processed your payment. Here's your next statement. And we send an email to the lender to let them know we've received the payment. And then they receive a another email or text message, depending on how they want it, stating that funds are being deposited in their account. I have a couple lenders who say that's their favorite email is coming from us, a little bing, and they look down and say, oh, they're sending more money. So
it's always good just to see the money coming in. Now, are you seeing a lot more people, because you get to see kind of behind the scenes, because, I mean, most investors are going through y'all's office, and you get to kind of see. So are a lot of people selling their notes, or are they keeping them a year or two until helping these people get their credit up and then having them refinance with banks? Or what is the kind of theme you're seeing right now between investors here in Dallas?
We've had probably a flood of people who we've been servicing for 3 to 4 top 5 years. So we've been servicing borrowers that are refinancing.
Yep.
We had 22 in the month of February, which is a short month. In March, I'm pretty sure, I don't know how many closed, but I know for a fact we did 96 payoffs. So, I mean, and I have 8 more that came in today. So we have quite a few that are paying off because I believe it has to do with our ability to report them for credit, and that they're able to move forward on these.
Yeah, so guys, when you're going to get into owner financing, you have a few different options, as far as what we were talking about originally. You can buy a house with cash, or you can buy it on owner financing from the homeowner, do a wrap mortgage or something like that, and then basically sell the note and capture some equity right now. Or you can and wait a few years and let that homeowner, because most of the time we're selling a house at a higher interest rate, say 9 or 10%, and then say a year or two from now, that homeowner is able to go get a qualified bank loan from the bank and finance out all their money for the full purchase price. Or you can just hold the loan throughout the loan if you have the ability to leave that money in long term, which is a good way to do it as well. Are you seeing a lot of companies coming in doing partial loans where they're creating 2 loans when they sell the property and selling the front loan and keeping the back loan? Or are you seeing a lot of creative stuff like this, or just basically plain black and white?
We see both. I was going to say we have a couple of, we probably average about 15 a month that come in that have a first at 85 and a second at 15, and they're selling those at the table because now the value of the note to what's owed is 85%. We have some that are coming through. They do what we internally call an override, which is they've sold the note, and the person putting it together is receiving 1 to 2% on every payment. So they have their own mailbox money, even though the only part they had in the game was putting the transaction together.
Yeah.
I think that's a pretty cool one. We have one that I'm looking at that just had a wire come in that the borrower had, but the lender had an underline. It was sold as a wrap, which is very common in Texas. Probably 30% of our portfolio is wrapped, 70% is owned free and clear. But this lender sat on it for 5 years, and we're sending out a payoff of $41,000. So, I mean,
not bad.
If you had to wait 5 years, that's a pretty awesome thing. You have an underline that's at 4% and the borrower paying 9.9. The spread gets larger as the time goes on.
Can you quickly touch on what a wrap mortgage is? Because a lot of people watching this are probably brand new in the business, and that may be a little bit over their head. And I know we just put a video out literally yesterday on our YouTube channel, Investor Army, about this, but she's probably going to do a lot better job explaining it than I did. And because this is a good way, because not all y'all can borrow money from a bank, not all y'all can get long-term money to wrap it. So you're going to have to, a lot of y'all take these houses subject to or buy them on owner financing direct from the homeowner. But go ahead and kind of explain that for them. So I think that'll help a lot of people.
There's 2 kinds. There's whether it's your house, your personal property, and you had the financing on it, and you moved on and you've sold it. So your mortgage on your home is at 3 or 4%, and you owe 89, and now the value is 120, and you sell it to your borrower at 9.9. You're making the difference between the P&I for the borrower's mortgage and your underlying. The difference is all your cash flow. Sometimes you'll find someone who needs to sell their house, they're behind, and you can bring their loan current for them, and you take it over as subject to. You take over their payments and guarantee that you will make their payments, and then you find a buyer for it, and you've wrapped the mortgage, and now your buyer is making the payments, and the underlying mortgage is getting paid with that, and you're making the cash flow on the difference. And it improves the person's loan that you took over, because hopefully you have a buyer that's making their payments on time, so it's improving their credit that may be behind and bring it current. Did I confuse you? You're making eyebrows.
No, I'm going with you right here, because I was about to ask you something else. So, okay, are you seeing more people doing subject to wraps, or are they just straight buying out owner financing and wrapping it that way? Because obviously you come into the situation, are you protecting the seller, right? So often you see in a subject to purchase, they have no deed of trust, so they have no remedy to get the property back. And then when you're wrapping it, at least it's more beneficial to them, I guess, as far as the protection. Or
we're seeing more wraps than subject to.
And it's also easier to get the homeowner to accept that type of offer because they do know that, you know, they have a little bit
for it.
Yeah. So I know we may be getting kind of off here in advance for a lot of people, but I did want to touch on, so when because I'm still a little unsure on this because I don't do too much of creating double notes. So like if you were to create, someone say they had a house and they were selling the note and they created two notes and they sold off the front part of the note and they kept the back end of the note. How is this being structured from y'all's side? Are both notes being paid simultaneously, or does the first note have to pay off in full and say 7 years later, once it's paid off, the second note kicks in and that person's making the second back end position is getting all the payment, or do y'all pay them simultaneously?
They're paid simultaneously.
Really? Okay. So that's good to know, because a lot of people don't want to have to wait till they get that second, you know, because I know some people that are doing that as a strategy is, you know, they create short-term notes, they create 7-8 year notes and sell off enough for the first 3 or 4 years to pay off their underlying lender that they did the deal with, and then they wait that time period, and when it kicks in, you know, they're getting all that cash flow then. But if you can pay it off, or you're getting that cash flow at the same time, that's the best way to do it.
Do it at the same time, and many times we have borrowers who just make one lump sum payment, and then the payment department has to sit there and divvy them up between the two.
Well, I think the reason why they do it is probably because if you really got into how you look at it, don't you get a higher yield holding the back end of the note, or once it kicks in, or am I way off there?
I'm not sure on that one.
So like if you were to
give me an example.
Like if you were to have a 10-year note, and say I bought a house for 25, sold it for 50 on payments, and I wanted to sell off the first 30,000 of payments. So I pay off my underlying lender for 25, I put a few $1,000s in my pocket, and I hold it back in $20,000 note. Well, as the loan pays off, wouldn't you be getting a higher yield on that second part of the note as it pays off? Or this is just what some people...
Well, the principal, you'd have more payments going to your principal than to your interest if it's down the road 5 years.
Exactly. So basically is what most people do. They want the back end of the note, because from what I understand is, you know, and this is not a strategy that I'm doing, so, you know, I may be way off here, that they're getting, instead of, say the original loan was at 10.25%, well, now when they're getting the back end, after the front part's paid off, they should be getting a higher yield, so a higher interest rate is kind of how it's supposed to work.
Interest rate would be the thing that basically, if you only sold off like the first 5 years, so much is only interest at the beginning. You basically get the note back with, you know, it's within a couple thousand of what it was originally. So then if you even wanted to go sell it, you could make a killing on it also. You're basically getting the same amount. You just let it sit there, and you paid off your underlying, so your debt's gone. We have a couple like that. We don't have a whole lot like that in our portfolio. Yeah.
Are you seeing a lot of people borrowing against the collateral of the loan to pull a loan against it? No, none of that.
Well, we see some lines where people have a line of credit, and they've done a launch which commits the deed of trust to that. So it's basically a wrap, but it's not, because it just is a line. So when it has a payoff, they would do a partial release against the lender's line or investor.
Okay, I got just one last question for you. I know you're a busy lady, and you got to get back. Everybody wants to know about, when you're talking about loans and talking about especially subject twos, when, you know, you're not paying off the underlying loan, the due on sale clause. What's the risk of this? How often are you seeing this become an issue? What type of scenario, if you have seen it be an issue, was it a special scenario, or kind of give people, because this is probably the most commonly asked question I get when we're talking about these types of investment strategies.
I used to say I'd only seen 3 due on sale clauses. I've now officially seen 4. For the number of notes we service, it's less than 0.01%. The 4 we've now seen, 1 was caused when the note was sold and a borrower was fully disabled and taxes went to 0, and somehow it got caught when they looked at it and said, wait a minute, that's not the name on there. And the borrower just refinanced. 2 other times, a borrower went into the bank and wanted to discuss their escrow analysis with the underlying lien holder, calling attention to themselves. And the 3rd one closed at a title company. The underlying mortgage didn't hold escrow, and the title company short paid on the property taxes by 9 cents, which basically means they just miskeyed. Instead of paying $52 56 cents. They paid 65, and the tax bill was over 3,000, and they missed by 9 cents. And the bank caught it because there was a 9-cent shortfall in the taxes.
Yep. So, I mean, guys, you shouldn't be worried about this, right? So, like, this is almost like a distraction for everybody because they're all so concerned about it. And she just told you it's hardly ever. And then, like, say, you know, they get hit by lightning and they do have the due on sale clause. I mean, you just simply finance out of it, or you sell the property. Like, you know, what would be the worst thing that could happen?
Well, 2 of them, we just saw the note be sold and the underlying was paid off. You know, they made their money sooner than they had planned on it. A borrower refinanced on the other 2. So, I mean, it both took care of themselves. And honestly, the bank really just wants to get paid.
Exactly. So they're not going to, you know, they're having as many issues as they can getting people to pay already. They're not going to take a performing loan back, especially if, say, someone's not making their payments. An experienced investor comes in that they know is a lot more likely to make the payments because it really is their business. It's their job to make these payments. They're not going to really make a big deal. And she just basically told you guys that this big, you know, scary thing that everybody's worried about, the due on sale clause, is if, say, you get bit by a shark, the odds of getting bit by a shark does happen to you, then you basically just make your money sooner. So I hope that kind of alleviates a lot of stress and worry for a lot of y'all that it's not that big a deal, and that because I've never really known anybody that's really badly been negatively affected by this situation. So that's why it's so weird to me that it's somehow this big fear for everybody. But
I think the hardest part with the wraps is ensuring that you have insurance placed on the mortgage correctly.
Yeah.
And that when there's an escrow analysis, that we receive it in a timely manner, because we have to give the borrowers notice ahead of time also regarding an escrow change, that you're on top of it and you provide that information.
Yeah. So can you kind of, sorry, I didn't mean to cut you off there. Can you kind of elaborate on that for people? So like when you're switching and you're putting the new, you know, the new investor on their insurance, is that what you're basically saying? Or
well, you can't put someone on the insurance. Whoever holds title has to be listed as the insured. So the new borrower or the buyer of that wrap is the one who will need to have an insurance policy, and you need to find an agent that works on wraps. And there's 2 that I know in the Dallas-Fort Worth area that do an excellent job. One is Alicia Lamb over at Best Texas Insurance, and the other one is Kim over at Heritage Insurance. Kim Stallings over at Heritage Insurance.
Yep. She was on the show, and she's great. So y'all are handling the payment. So a lot of people's concern is that, you know, what happens if they wrap a mortgage, they're making the payment, and the person that they bought the house from is not making the payment to their bank, right? So y'all handle that directly to the bank, or
if the borrower, say again, I missed that.
Yeah, so like if we did a wrap mortgage and I bought the house subject to, or just say I bought the house subject to, and I created a new loan, and I'm paying the person I bought the house from whatever a month, say $800 is my PI.
Okay.
They owe their bank $650.
Okay.
I want to make sure that they're paying that $650 to the bank, because I don't want to get foreclosed on and find out later that they were just pocketing those payments. And that's what y'all handle, right? Y'all handle it goes directly to the bank if that first seller is involved in the process working with y'all.
Correct. Many times they're not, but sometimes they are. We send the payments directly to the bank. We recommend that, if possible, to have the underlying paid a payment ahead, just so if your borrower runs late, since their payments many times are due on the 1st, late on the 10th, if they're running late with the underlying being due on the 1st and late on the 15th, that they are hopefully a payment ahead, so there's not a late fee or phone calls going out. So even though it won't affect your credit until it's actually 30 days late.
So guys, that's really important, because if you've already gotten through all the headache part and you've actually got someone who's willing to go ahead and let you take their house subject to, you've already got through the difficult part. Might as well go ahead and let them understand the whole loan servicing process, because you don't want to make those payments to them and find out later that, you know, they're not making the payments, which is really the risk in my mind. But do you have anything else that you think that we didn't cover that you want to tell people about what you do? And then if not, how they get a hold of you? And we'll put your links under the video here, and we'll share you all around, let everybody find you. And as you know, I'm a big believer in what you are doing there. And I think you're helping a lot of investors out, and I'm glad to have you on today. But if you got any last minute words of wisdom, I think people would love to hear it from you, because you're an important person here.
And that would be, if you're choosing to do a wrap, that you ensure that you have the underlying lien holder's social. So if you need to get a payoff on that mortgage, and they have moved on, gotten divorced, changed names, that you have that
Yeah.
information and that you are authorized on the account, that you fill out the correct information of the bank,
Yeah.
and that you change the mailing address for those statements. So they're either coming to you or they're coming to us. We open each statement every month and make sure those payments are getting applied. Or we're receiving the escrow analysis, which we have a ton right now.
Yeah.
It's that time of year where we're getting those escrow analysis, and we're doing that part. It's really hard if you don't have access to that underlying mortgage to ensure that it's being paid properly, or notification if it's been sold.
Yeah. Are you ever dealing with an issue where someone passes away and they're the only ones on that you could find? Like, what would happen in a scenario like that?
Well, we had one today.
Oh, wow.
So I was smiling. Not that we're happy someone died at all.
Meltdown mode.
You know, we call the numbers and you can't get a hold of them, and then I'm like, well, you type in their name and type in obit, and it pops up, and you're like, oh, this isn't good. So you have to figure out. But we have a lot of issues. One of the things that we do a lot of work with is insurance checks, and this was on an insurance check. We need someone to endorse it for us because the lender is listed on there, and we have currently 4 lenders on our portfolio who have passed away, and it's being handled by their estates. So it happens.
That's always been my fear, is what type of headache am I going to get into when that happens?
Well, always have the option to sell the note, but on this one, his heirs are taking care of the payments, and we're going to have them endorse that insurance check. We have a ton of insurance. Why insurance is so important on a wrap is ensuring it's done correctly is, we live in Texas. If you're in Houston, you have a windstorm, you could have flooding, we have hurricanes. The rest of the state, we have our own earthquakes, windstorms, tornadoes, hail damage, a lot of that. So, our escrow department deals with a lot of insurance checks and ensuring they're getting released, and talking to borrowers and explaining to them that if you have a roof claim, don't pay it to some roofing company from out of state and give them all your money. They could walk with it. Yeah. We would be happy to pay them directly, ensure they're not going to put a lien. We have a paid invoice on it, and we want a picture of the roof saying it's done completely. Not, they say go ahead and release it. They'll come back and pick up the shingles. No, they can pick up the shingles, and then we'll release their money. Yeah. Make sure you're happy with the job and that it's complete before we send out money and help them out. So some of it's first-time home buyers who they don't know those things. So we have a lot of appointments reviewing what an escrow analysis is, because they understand that their payment's never going to change, and we have to walk through that's your principal and interest payment. It has a fixed rate, but taxes and insurance can go up or down, and usually up. Yeah. And help people file for their homesteads. So we love what we do. It's a lot of fun.
Well, Amy, as always, you are awesome. I'm glad you came on today. I think you helped a lot of people. And if you guys are getting into owner financing, you need to call August REI and see what they can do for you, because I highly recommend not going into that type of the business, that type of strategy, without kind of knowing that you got someone standing over your shoulder to help you do it correctly. Plus, the benefit they give you when you go back to sell the note on the backside is just going to make you a lot more money. So that they're worth their weight in gold. Amy's a great person. And do you want to give them any contact information, or do you just want us to put it below under the video, or how do you want us to do it?
You can put it below. I was going to say info at August REI.
Awesome.
And put our information in there.
Are you going to be out at the REI Expo this year? Are you going to have a booth?
Which one? We're going to a couple this year.
Well then, guys, I guess
REI Expos.
I think there's a big one coming up next weekend, huh? I think the Think Realty event,
there's one down in San Antonio that's next weekend.
Okay.
There's that one. There's one coming up that's in Dallas. We're going to do a couple of them. I'd have to check our calendar.
Yeah.
We've gone to the San Antonio one a couple times. There's one in Dallas periodically. Tim's, formerly known as Tim's. That one.
All right, Amy. I appreciate you coming on here today.
Thank you so much.
Continue on doing what you're doing. You're helping a lot of investors up here have a lot less headaches. I can guarantee you that.
Well, thank you. I appreciate that. Thanks for having me.
Have a good day.